Hey, everyone, we'll just get started in a couple of minutes. Just wait for people to slowly join the session. We'll be going probably in the next minute or so. Hey, everyone, thanks for joining. Hopefully you can all hear and see me. I think we've got Phil from Xact Accounting joining in. Josh and Sue should be coming in. There we go. Awesome.
Hey, Jules.
Hey,
Brilliant. You
Jules.
guys can hear me okay?
Loud and clear.
Loud and clear.
Brilliant. So thanks, guys, for coming along, and thanks for Mitre for sending this out to everyone, and really appreciate you all jumping on. There will be a recording that we'll have from the session as well. So if you've forgotten to take a note down, or you're listening while you're driving or something like that, you'll be able to go and watch this back afterwards. So no problem there at all. But yeah, we've got a bunch of people. There's still people slowly trickling in, so we'll probably get people joining over the next 5 minutes or so, which generally seems to happen. But I guess what we're here for is we're almost at the end of the financial year. You don't want to hear any tax or any those kind of talking points or advice from me. So we bring in the best in the business to do that. And that's Xact Accounting. If you haven't jumped on one of our webinars before, we do have these guys on quite a lot because they are the experts in this space for construction. And so, a story I tell quite a bit, but I'll tell it again. I used to work at MYOB in the past, and I used to work with bookkeepers and accountants. And a lot of my role was to help them try and bring on more clients in their business and service their clients better. And this was at a time where traditionally accountants and bookkeepers was very sort of, the level of engagement and services they offered was very limited. So bookkeepers, a lot of it was just data entry, and accountants was really just around tax, at the end of the year, or maybe a couple of times through the year as well. So what's happened in that time is people have gone deeper in the relationships with clients, and that's changed. And one of the big things that I used to see when I was working at MYB, working with bookkeepers and accountants, is you saw a lot of these people work with multiple industries. I don't care what anyone on the planet tells you, especially if you're a smaller practice, there is no way you can be across that many industries and know your, about everything. There's just no way. You can't keep, even just with apps and software, you can't keep up to date with all the manufacturing apps that are there, with the hospitality stuff, like all the stuff that, manage tables and services and inventory. And if you're doing construction, all the trade apps that are around, even just trades in construction is a lot in itself to try and keep up to date with everything. So what I used to always speak to people about, you need to try and focus on a particular niche. You'll give a better service to your customers, more advisory conversations that you can have with them, help them set up their business and perform well over a longer period of time, rather than just kind of doing the generic transaction data entry, that kind of stuff. So Xact Accounting are those guys in the construction space. Super wealth of knowledge on this call. I'm not sure what an accountant is an hour at the moment, but it's a lot more expensive than free. So this is a free session. You haven't paid to join. Maybe Josh and Suze will tell us what their hourly rate is later on.
No, we're not talking about that, mate. We're talking about hourly rates. It's all about value.
Yeah, well, it's just really, I guess it's the hourly rate of the people that are on the call. That's what they're paying. So hopefully we can
that's right.
Exactly.
deliver some value there.
Yeah, brilliant. So we've done the session a few times. A lot of different questions come in, guys. So please keep your questions coming in. Obviously, just when you're doing it, just use the everyone option when you send it in. But I'll throw over to Phil for a short minute there, just to let him. Sorry, I'm getting a call at the same time of any webinars on. I'm not sure. I think their team's allowed that to happen. But yeah, I'll throw over to Phil to introduce Josh and Susan what Xact Accounting do.
Thanks, Jules. My pronouns are him and he, or whatever they are, just in case you get a bit confused there. But yeah, thanks, Jules, for having us, mate. Like Jules said, we do quite a few of these type webinars with Build Xact. We think they're, great option in the market, and just good people to work with as well, which is always a plus. So yeah, we're going to do this tax time tips. There's 3 of us from Xact that are on the call today. I'm going to sort of, come in and out of the conversation. Really, the talent today, the people, the experts, Suze and Josh. All 3 of us are partners in the firm. But yeah, Suze and Josh are the real tax experts in our world. So they're going to be sharing the bulk of the content. Just quickly, though, I'm just going to quickly give a quick overview of what we do. So we do 3 core services, starting with bookkeeping. And like Jules said, this has changed significantly over the years. It used to be just about manually data entering in invoices and the like. These days, bookkeeping is as much system integration, making sure, Build Xact Zero, Deputy, whatever other systems you've got in place are all talking to each other, and you've got a good workflow around it. So we come at bookkeeping from a specialist building and construction perspective. We do tax as well, so compliance, bit of an industry term, but compliance, accounting, which is tax, structuring. We do a lot of licensing work as well in, say, New South Wales with iCare and with Queensland in QBCC, that sort of stuff as well out of our compliance team. And then CFO advisory. So that team is all about commercial accounting as opposed to tax accounting. And the CFO advisory guys have a portfolio of clients they work with, sort of 10 to 15, and they act as a part-time CFO to those businesses that are trying to scale and need that kind of level of finance plugged into the business. Our clients are usually scaling up, so they're growing and trying to handle all the complexity that comes with growth. They want to learn more about their business, and particularly the areas that they're not necessarily as comfortable with, like the finance function. They're starting to recognise that, like Jules said at the top, that they probably are after someone that's more of a specialist in the industry rather than butcher, baker, candlestick maker. That they're after someone who really knows their industry. And they're looking for a finance running mate. So they're going to be, like the CEO of their business, and they need a CFO or a finance partner to come in from the side and really, help them on that finance journey, which in building and construction, with such a risky kind of market that we all operate in, that's really critical, particularly if you want to grow. Housekeeping for today, the agenda. We're going to go through some first principles around tax and how we come at the whole tax space. And then we're going to go on a tax journey. We've tried to cover content for whether you're just starting out, whether you're starting to spin a profit and you need to know how to handle that. And then finally, if you're really nailing it and you've got really decent profits coming in, how can you get shall we say, a little bit more creative about how you want to go about your accounting work. We're going to have some polls along the way. So partly for interactivity, keep everyone awake this morning, that kind of gear, but also as a way for you, if you are interested in some resources, that you can reach out to us using the polls. It's just easier than, QR codes and all that sort of gear. We're going to have questions, drop them into the chat as we go. We've broken the content up into 3 sections, though. So we'll answer some as we go if we can, but then we'll probably then just come up for air at the end of each section so that we can answer questions that relate to that section. Please don't worry about what type of question you're asking. There are no silly questions. Don't miss the opportunity to ask Suze and Josh, while you've got the experts on the call, any of the questions you might have. The caveat to that is sometimes we get some more technical questions. Often we have accountants on these calls as well, and they want to get down into the weeds. We're happy to answer those questions, but we don't want to lose the rest of the audience. And a lot of that gets quite specific too. And so, you need to kind of understand all the different nuances that are going on to answer some of those questions, which we can't do on a call like this. Finally, we have an ebook that will be coming out. So any of the stuff we're going to cover today, we kind of go a bit longer in the ebook as well. So you'll have that as a resource to follow up with. Jules, do you want to? It'd be probably nice just to check in on everyone, where they're from, all that sort of stuff. Do you want to have a crack at that?
Yeah, for sure. But before I jump into that, Phil, I just want to just give some stories and kind of like to back up kind of what I was saying earlier on as well. Is Well, again, when I was at MYOB, there was a partner that I was working with at the time that when we're talking about going online, and her response to me was, why would I put my clients online? Because it means that they can do everything really cheaply and they don't need me anymore.
Yeah.
And even when I was at Build Xact, when I first joined in, I was bringing on partners onto the platform, and one of the guys said, why would I recommend Build Xact? It's too easy for them, and I want to implement software, and it means that I lose money because they don't need me to implement a software. And the point I'm trying to make with this stuff is surrounding the best possible people around your business is really, really imperative to having that, because there are people that will just look out solely for themselves. And this is kind of like why these sessions are really, really important. And obviously, just to kind of give Mitre 10 props here as well, is that them sending this out and them trying to get their audience engaged into this kind of content is really, really important for the industry. And it is starting to happen where more and more people are sending this and realizing the importance of this, rather than just the normal stuff that people tend to send. So I just really want to thank Mitre 10 again for passing this out through their audience as well. But let's do a little bit of a where people are here from today. So let's go into the chat. So if you guys can just open up the chat, just make sure you select everyone in there, and just can you pop in where you are in the country, just so we have a bit of an idea about where people are dialing in from. And if you don't put it in, I'm going to pick on you. So we've got Sydney,
Melbourne,
Dubbo, Coffs Harbour, Blue Mountain saying Phil.
Thank you, Phil.
Melbourne, Dubbo.
Coffs Harbour. I love a bit of Coffs Harbour.
Launceston.
Dubbo. My in-laws live in Parks, just near Dubbo. It's nice, pretty green out there, I think, still at the moment. There's not a few people from Dubbo. Lake. Now, how do you pronounce that one? Lake, Cathie. Jules, do you know how to pronounce that one?
Mate, as you can tell from my accent, I'm not a local to Australian suburbs and places. So
it's actually I'm pretty sure it's Lake Cathie. It's near Port Macquarie, I think, Lars.
Okay.
And Tassie. Oh my God. Well,
Tassie today.
Yeah, we've got a few Tassies here, haven't we? A couple of Lonnies. Was there 3 maybe from Lonnie? Awesome, cool. Thanks for that, guys. And in terms of when you joined the webinar today, what were you looking to get out from it? If you can just pop in what you're looking, and it might just be that you just hear from general advice. That's cool. Just pop that in the chat as well.
Yeah, but if there's something sort of any specific area that you're scratching your head about, you want a bit more information on, then pop that in the chat so that we can, I guess, get a good read on that and make sure that we cover off on it as well. If there's anything specific, looks like most people are after general advice.
I think once Jade put in general advice, it just gave everyone an easy out, which I think everyone's taken. So, awesome.
Tax incentives, possible structure, business, sole trader to company. We're actually even starting there, Dal. That's what we're going to cover for sure. Temp full expensing, and then end of financial year tips, sprinkled along the way, really, that one.
Yeah. Should we get stuck in, guys?
Let's go. I reckon.
Awesome. I'll turn my camera and my video off, but I'll be popping in and out like Phil said there. So I'll leave you with the team here at Xact Accounting, guys.
Yes, thanks, Jules. And yeah, again, thanks to Mitre 10 as well. We do appreciate it. It's, it's a tricky space, some of this financial stuff. So it's great that they care about their clients to get in behind this sort of stuff. So let's go. Before we get going though, I just wanted to, this is a disclaimer slide to say that the information we're covering today is going to be general. It just has to be, it's a webinar. And so we haven't really taken into account what's going on for you, your specific circumstances, etc. We've also got some examples that we're going to walk through today. We've sort of generalized a bit there too. We've made them a bit quite simple in a way to try and convey the message and the concept behind them. And so obviously there's always other factors that are going to come into play. But in the end, please consult your accountant, a lawyer if that's required as well, whatever services you need before you make a decision on any of this sort of stuff, so that they're looking after you. In terms of just some first principles here, we come at accounting and tax in particular from, there's a few things we try and balance. One of those, or a couple of those, is the tax strategy versus commercial strategy. So we look at tax and we say, look, there might be an opportunity to save some money on tax here, but if it doesn't make sense from a commercial perspective, then we wouldn't recommend you go down that road. So, for example, it might be good to sort of, take advantage of buying a new car, a ute, because you want to, get a tax benefit as a result of that. But if the cash flow doesn't support that position in the business right now, then we wouldn't recommend it. So we're always sort of just trying to come at things from that perspective. The other thing is we're trying to balance tax law, so what you're able to do under the legislation, and as that's changing year in, year out, versus the tax opportunity. And that's a balancing act too. We are, if you're on the call today, try and find an accountant who's going to, do some questionable things. That's just not us. We're going to take people as far as we can to the line, but we don't want you to go to sleep at night and worry about that if you had an audit tomorrow. And ATO are getting pretty good with their data matching around being able to join the dots these days. We don't want you to lie in bed awake worried about what you're doing from a tax perspective, because that's a very real problem. So we try and balance those things as well. And then finally, we do this thing where we reckon that your tax and what you're doing from a tax perspective for the business, it has to be a partnership between you and your accountant. So it's great that you're all here today, that you're leaning in on this area and wanting to know more, because you really just can't leave it to your accountant. I mean, they should be proactive themselves, and they should be coming to you with suggestions on how to do better in this space. But that whole arrangement gets better if you level up in terms of your understanding, your financial literacy. So we would just sort of, again, thank you for joining, and it's really good that you're getting involved with this sort of stuff, and recommend you keep doing that. So this tax journey, as I mentioned, we're going to do newbie content, hat structure, those sorts of things, and then some of the basic kind of expenses that you want to be looking at and in terms of claiming for. Getting there when you're starting to get some profits, what are you going to do with those profits? And then nailing it when you're getting some really decent profits and you want to get even, I guess, more tactical about how you handle the tax challenges in that space, ultimately so that you're not handing a cent over more than you want to. And so the final thing we'll cover at the end of the day is if you're on fire, that's an ambulance there, not a fire truck, Jules. I still haven't changed it. If you are on fire from a tax perspective and you've got quite a bit of ATO debt or other debts as well, there's some options that are really quite useful in the market now. And so we're going to cover off on that right at the end for those people who are in that situation as well. Righto, that's enough from me. I'm going to step back now, and I'm going to introduce you to Suze, who's going to go through structuring.
Good morning, everyone. Thanks, Phil. It's great to have everyone here on the webinar today. And as Phil said, we are breaking this into 3 sections. So keeping in mind right now, we're dealing with those of you that are in that newbie phase or just starting out. So typically in this stage, we see most of you will either be a sole trader, or you may have taken the leap and launched straight in as a company. And mostly we see sole traders in this space because it's so easy and cheap to set up. You don't need to register anything other than an ABN and you're good to go. Most accountants will tell you it would be ideal if you could set up a bank account at this point to keep your business money separate from your personal money. But I mean, the only other disadvantages of being a sole trader, a couple of them really, is your asset protection is a big one. So all of your assets, including business assets and personal assets, are all grouped together as you as the only owner of those. Why is that an issue? If something goes wrong in the business, for example, then all assets are potentially at risk in an issue with creditors. The other issue you've got with a sole trader is your tax rates. You are taxed at marginal tax rates on all of your income. And so all your income is grouped together, work out what your tax is, and you could be paying higher rates of tax than potentially if you are trading as a company. And we'll talk a little bit about that a little bit later on this morning. What we've sort of mentioned already, but with a company, you do get better protection for your assets because you are setting up as a separate legal entity. And you do get a flat tax rate of 25%. So you don't have those incremental increases that you get with the marginal tax rates. So there's a couple of options that we have there. We do still see some people in the newbie space trading as in a partnership, but less and less common these days. It has similar issues to that of a sole trader. So all of your assets are potentially at risk because it's all in personal names. And you are still paying tax at marginal tax rates. So that's generally where we see structure sitting at this point in your journey. Josh is going to have a bit of a chat now about technology in this space.
Absolutely. You might think tax webinar, why we're going to have a talk about tech stack, but very similar to what Sue's talking about. The structuring is important to do up front as well as your tech stack. So these days we operate in very much a digital world these days, and for businesses to really succeed, we need to be leaning into available technologies and pretty much cloud-based technologies these days. So unashamedly, we're going to actually share with you what we think is a perfect stack for building construction businesses, particularly in the residential space. So looking at this stack, I'll unpack this a little bit and why this is important, but looking at a connected ecosystem of having data collection, which is that DEXT receipt capture information, also having an estimating platform, job management and costing platform, such as Xact, and then also all roads leading to Rome to an accounting software ultimately, which is where all your reporting sort of falls out. So the importance of tech stack is really to make sure that you're doing things accurately and collecting data in the right way and giving you the right information. But there's plenty of different ways you can put a tech stack together. There's many different versions of a tech stack. But the key thing that we really want to drive at around selecting a tech stack is it needs to be actually connected to each other, and there's actual integration between these platforms. So talking through this, I'll just walk you through this tech stack because we strongly believe this is a best practice tech stack in this space. So DEXT is a receipt capture software, so you get your receipts. If you get them on email, it's still very useful, but the whole idea with it is it can read data using AI, and it can just speed up the data processing of the information that's coming in from your subby suppliers. All of that is captured. It's then flowing dynamically into your accounting software, such as Xero. And the key part that we want to highlight, particularly with the Xact piece, is that there is a two-way sync, because one of the key things you need to be doing is doing job by job costing and having actual data. And Xact does that in their financial module. And the good thing is this information is all linked in that ecosystem. So Xact, Xero, DEXT all talk to each other in the right way. And so from the Xact side, let's just unpack Xact quickly, is one very neat part of that ecosystem is Mitre 10, as an example, has their live pricing in the back of Xact from the estimating front end. So you've got live data coming into Xact from your estimating, and then once you kick off the job, you've then got live data coming in on your job costing, which is flowing through the receipt capture, flowing through Xero, and really giving you the best picture of how you're performing as a business. And it's all comes around, good data in, good data out. Is basically what we're driving at, because building construction businesses are quite unique. There's a lot of moving parts, and you just need to have the most dynamic reporting possible to make sure that you are on track. So Build Xact has excellent dashboarding in this as well, and Phil will jump in and Jules will jump in as well, because we want to make sure that we really drive on the tech stack a bit. But we've got dashboarding in Xero, we've got dashboarding in Xact, Build Xact, and it is all about having the right data. Now, one point before Phil or Jules jump in here is, albeit all these softwares connect to each other, you really do need to have specialists actually connecting them in the right way, because you can't just flick the button and it all works. You do need to spend some time setting it up so that it is in best practice format in terms of what charts of accounts, how you're mapping it to Build Xact, etc. So you do need to spend some time around that. Our bookkeeping team at Xact actually spent a lot of time with this tech stack, and we understand how to connect this tech stack as well. Phil, I see you chomping at the bit, mate.
Just the Dex, there's a few things in play here. That we often get questions like, can I match the purchase orders? Yep. Can I match the jobs? Yep. And there are other options like HubDoc around, from Xero, that are actually free. There is a small subscription from Dex. I think it's like $25 a month or something. We prefer it because it's the AI in it is very clever, and it matches to your, like, the predictive AI, so it'll really predict which accounts it should be coded to really smartly. Probably looking at this, we've left a big one off here, which is time and attendance. Again, there are a range of options, Deputy, all those sorts of platforms around. We actually don't mind Xero Me, because you can actually, code to jobs. You can split it out from COGS to overhead. If that's split, like if you're an owner and you want some of your wage to go to COGS and you want some of it to go to overheads, you can do that as well. But yeah, in terms of getting the reporting you want out at the bottom end, it's just not possible if you don't have these platforms talking to each other. And you can actually do it yourself, but just to get a kind of a best practice approach, it's good to dial someone in to help you with that. So we might keep moving. I think we've got a poll at this one because we just wanted to see if anyone is interested. Jules, can you pop that poll up? This one is about if you need a hand connecting up the stack, then let us know. We'd be more than happy to help out. I know Build Xact can help with that as well, but we can help you connect up the plumbing, if you will, to make sure all that is working the way you'd like it to. Righto, we might keep moving. So we're going to move on to purchasing a vehicle, and that is Suze.
Yeah, so a few options you've got here and things to consider when you're looking at purchasing a vehicle. It's something we hear quite commonly this time of year. It seems to be lots of builders, tradies and so forth are looking at, do I need to replace some vehicles right now? And with the instant asset write-off we've had in previous years, a lot of people look at this as something that needs to happen by 30 June. The first thing I would point out in relation to vehicles is the instant asset write-off is sort of gone. We've got a cap now at 20,000, so your asset must cost less than 20,000 to get it as an immediate deduction. Any asset that costs more than 20,000 falls back under the usual depreciation rules that we've had in the past. So that is basically going to preclude most vehicles at this point in time, unless you're looking at something relatively cheap or secondhand. But in the case of most of you guys with your utes and trucks and those sorts of things, you're going to be looking at that higher end. And so you are going to be tipped out of the immediate asset write-off these days, and it's going to go back to normal depreciation. So a couple of things to remember. Luxury car tax is a real thing. It's imposed at dealer end. It's not a tax thing that's put through tax returns or those sorts of things. It is imposed at dealer level, and it's imposed if your vehicle costs more than around $79,000. So just be aware that you will get hit with a little bit extra there if you are paying more than 79. Depreciation has a cap as well. It's around 68,000. I can never remember the exact amount, 700 and something. And it means that even if the vehicle costs you 80,000 or 100,000, you only get to claim up to the $68,000 limit for depreciation purposes. So anything above that, unfortunately, you lose a tax deduction for that extra part above that 68,000. GST is also capped in line with the depreciation limit. So your 68,000 or about 6.5 in GST is it in terms of your tax deductions and GST rebates that you can get back in relation to that. So we're going to have a quick look at an example. We've got a Hilux here, drive-away price $59.74. Because it's over the 20,000, we can't get the instant asset write-off this year, so we have to depreciate. Vehicles are usually depreciated over a 4-year period. That means that you can claim about $11,500 per year as your tax depreciation amount. Because we're under the depreciation limit, we get the full amount or full benefit of that depreciation over the 4 years. That equates to, as I said, $11,500 of a tax deduction per year, and you get a $4,500 thereabout credit for your GST. So having a look at how you could then potentially claim your expenses in relation to your vehicle. As a sole trader, remembering we're still in the newbie space, you've got two options. You've got a cents per kilometre method, or you've got your logbook method. Your cents per kilometre, and we've got some worked examples coming up, you're capped at 5,000 kilometres per year. So there is nothing more you can claim on your vehicle except for that 5,000 kilometres if that's the method that you choose. We typically see most of you guys in this space would track way more than 5,000. We often see 20, 25, 30,000 because you're going in between job sites all the time. So we often find that your rate of claim would be much better under the logbook method. So as you can see, the cents per kilometre, we're capped at the 5,000. That gives us a maximum claim, not even a tax refund. It's just the claim of 4,250. If instead we look at the logbook method, and remember, to have a valid logbook, it needs to be kept for a minimum of a 12-week period, consecutive 12-week period. You need to make sure that you're tracking your opening and closing odometers and the purpose of each trip. You actually, to have a valid logbook, need to track all your mileage, not just your work-related trips. So you just make a note if it's a personal trip, etc. So we've done an example here where we've got our logbook. We've said it's an 85% work-related purpose that the vehicle's used for. We've outlined our expenses there. We've got total expenses for the year of about $23,500. When we apply our 85% logbook, we get a claim actually closer to $20,000 as opposed to your cents per kilometre of 4,250. So I don't know about you, but I think I'd rather save $9,500 in tax by having my logbook and bumping my claim up to that higher level than running just at that capped 5,000 kilometres. So just keep in mind there are those options, and you might find a better option is your logbook usage. Josh is going to talk us through some home office.
Yeah, so home office is an interesting one. It's been a little unnecessarily confusing over the last few years with a few changes and ways you could do it and proportioning year approaches. But we just want to quickly high level the three sort of pillars of home office and how you actually claim these costs. So in the first instance, it's very similar to motor vehicles, to be honest. There's a fixed rate per hour approach, which is the simple on the couch approach, no receipts required. Here's a flat rate. There's the actual cost method as well, which is the more detailed logbook and actual costs and receipts method. And in addition to both of those two methods, the fixed rate and actual costs, there's an additional occupancy where you have no other place of business. So we might just quickly unpack some of these now. So the fixed rate is quite simple. It's a 67 per hour rate. It incorporates all of those costs, the internet, phone, all of those inputs into the home office costs. And it's simple as that. You do need to keep a record of actual hours. You don't have to keep a complex logbook or anything like that, but you do need to show diary records, calendar, that you're working from home and can actually prove some hours if questioned. And in addition to that, if you have any other assets, like you've had to buy desks, chairs, etc., you can claim in addition to the cent amount an actual depreciation. If the asset costs less than 300, you get to claim an immediate write-off for it. If it costs more than 300, you do then just need to claim the depreciation, or you claim the cost over its effective life, usually a couple of years. Now, the actual cost method. So this is where you do actually have a dedicated office in your house. You might have a room where you go in there, but it could still be mixed purpose. So You might still use it personally as well as for work-related purposes. Now, this one, there's a few different ways you sort of have to claim it. And so at the simplest form, it is looking at your actual receipts of it, internet, phone, energy, and then looking at how, in terms of units, because let's talk about internet for a second, or even we'll talk about power actually. So it's all measured in usually kilowatt hours and cost per hour. You basically need to look at either your actual hours for a whole year, keep track of all the actual hours, or you keep a logbook for a 4-week representative period, right? So you look at the hours that you're actually at home based on your logbook, and then look at how many units that you're consumed linked to that home office. So you just times by the units and the work hours that you've collected, and that gives you the claim for those costs. And you do the same thing with phone, internet, and those sort of things. Now, cleaning's a weird one. We just threw it in here quickly. If you do actually pay for a cleaner to come and clean your home, it's simply based on a square meter type approach. So that dedicated office in the house as a proportion of the total house, that's the claim that you make for cleaning. Similar to fixed rate, if you do have assets, again, desks, chairs, those sort of things, you can claim a deduction under 300, depreciate over 300. And so the key thing around the actual cost is you do need to keep records and receipts for all of the costs that you're claiming for. And that's the bit that got a little bit more complicated compared to prior years, where they sort of basically want you to do a full logbook method. Now, an extension to both of these is the occupancy claim for home office. So the real strict requirement around this is that you do need to prove that you have no other place of work. So you don't have an office that you can go to. There's no other alternate actual place of business. All business and work is done at home. And it's not quite the same as actual cost. We have a dedicated office where you could use it personally or not. Occupancy, if you want to start claiming under this cost, you do need to have a very defined area of your home that is only used for business purposes. So you firstly have to tick that box on having a very dedicated area for it. Assuming you do tick that box, then we're looking at a square meter type claim. So that dedicated space or exclusive space is probably the word I'm going to use, exclusive space as a proportion of the total home gives you your percentage, and then you can start looking at claiming things like mortgage interest, or if you're renting, rent rates, all those sort of things. And so that obviously can make the claim for home office quite a bit larger, particularly if you're spending most of your time actually at that office at home, you have no other place of business. The big thing to be aware of, though, and Suze will actually talk about this a bit later on too around CGT, but be aware of capital gains tax. We all sort of have it in our mind that if we own our home and we sell it, there's no tax implications. Generally, that might be true, but if you do start claiming for occupancy costs, you may find that there is a taxable outcome for your home later on. So the best thing is to, before you go jumping and claiming those things, make sure you're talking and getting the right tax advice around that before you do that. That's home office. I think, Suze, let's talk about bad debts.
Yeah, so bad debts is a really good one to review, particularly this time of year. Ideally, prior to 30 June, go through your age receivables listing and have a look at any customers that may not have paid you, typically in the last 12 months. So you might have invoiced them last financial year but haven't recovered the money yet. Is a good opportunity for you to actually write that off and claim the expense now, rather than deferring it and keeping it sitting there as legitimately income that you've paid tax on. You could actually be writing that off. So we're looking at debts, as I said, that are older than 12 months. You have to have made a reasonable attempt to recover those. What does reasonable attempt mean? If you've got a debtors policy, you have to have worked through that effectively. If you don't have a debtors policy, you should have at least done some follow-ups, maybe made some phone calls, sent some emails, might have even engaged a debt collector, and you still haven't been paid. I think that's enough to say you've attempted to reasonably recover it. Depending on your circumstances, these actually could be quite significant amounts. So if you're a builder and you've invoiced for variations or different things like that, but you've not been paid for those, or you're in dispute with your customer over some of that, you could be looking at, hundreds of thousands, well, not hundreds, tens of thousands in terms of a bad debt claim, which could see you significantly reducing some of your tax obligations there. So yeah, so things to remember, just make sure that you are looking at things that are older than 12 months. You've made a reasonable attempt to recover and you've potentially got a bad debt opportunity there. A question we often get asked, what if I get paid that money in the future? So they turn around and say, oh, okay, yes, we acknowledge that, we're going to pay it. It means you would have to report that again as income when you receive that in the future. But for now, have a look at it, review it, write it off. And if you do end up recovering it, great for cash flow. You just have to remember there might be a little bit of tax you've got to pay on that at that point in time. And I think Phil's going to chime in. We've got a bit of another poll coming up.
Yeah, this is so WIP, work in progress. If you're a builder or if you're doing anything sort of project related in particular, and you're carrying what we call work in progress, there's often confusion in this space. Just generally, how do I work out WIP? And unfortunately, it confuses people more than it should. So part of that confusion from a tax perspective is people being concerned that WIP will increase their taxable income. It doesn't. It's not a taxable item. And so I guess we just wanted to make sure that people were clear on that. The other thing is that, like I said, it is a tricky thing to calculate sometimes. So we've put together a calculator, and it's pretty easy to drive. It's built specifically for people with multiple projects on the go, so that they can plug in each of the projects. So we often get a lot of interest in that area. So we thought that if people were interested in getting a copy of that, then we can get that out to you. So Jules, if you wanted to just pop that poll on, if you'd like us to send the WIP calculator, it comes along with a video from a webinar that we did last year, and allows you to, I guess, watch through how to use the tool itself. So it's sort of self-guided kind of thing. But yeah, if you're interested in that, but again, it's not a taxable item, so don't get confused by that part of it. That's for sure. Okay, we are going to move on, and I think Josh, you're going to talk about getting your house in order in terms of provisioning for tax.
Yeah,
putting some money aside, right?
Put some money aside. That's right. It sounds simple, but it's very impactful, and it just helps businesses make sure that you're not caught out. So, provisioning for tax. Firstly, you need to be making sure you're looking at your financial position, talking to your accountant, have a good picture of what tax is actually accumulating in my business, and that can be obviously employee tax if you've got employees, GST, and then obviously business tax itself, like income tax. So first thing is make sure, and this is why we talked about tech stack in the early part, make sure you're actually looking at your financials, using things like dashboards, etc., just to really understand what your tax obligations are. The next thing is a really simple form is open an actual tax savings bank account. It sounds quite simple, but you'll be surprised at how good you can get into a rhythm of actually setting the money aside into a savings account, because you're forcing yourself to put it to a side. So it's front of mind. And then, as I was saying before, talking to your tax accountant on sort of doing some planning. So not just for now, but also looking for the next 12 months and just getting an idea of what it could look like. It won't necessarily be perfect. It's hard to predict 12 months perfectly, but you do need to have some sort of level of estimating it. And as we're saying, using accounting software makes doing that sort of stuff much, much easier. Now, there is a rule of thumb way that you can do this. So if you want to keep things simple, because you still might be growing, you might be new to business, and so it's a bit hard to predict exactly what's happening going forward. So we had a chat at our end here, Xact, Phil, Suzanne, and I. We thought, well, what's the best practice way of doing this? What's a sort of rule of thumb? And so we've come up with basically 3% of gross revenue is a probably good way to provision for your tax. So looking at that monthly, putting 3% of your gross revenue aside monthly is probably going to get you pretty close to what you need. And that's based on some sort of best practice margin numbers that we're looking at as well, in terms of, making a 20% margin, not having your overheads more than sort of 10%. So you're aiming for sort of a 10% net profit annually. And so boiling it down to a percentage from there is sort of how we come up with that quick rule of thumb.
Just quickly on that, yeah, and as Josh said, we kind of use that on an averaging kind of basis, based on margins that we see in the market. If you've got a lot going on though, if there's more complexity, you've got multiple projects, really that should be a regular conversation with your accountant to make sure that you are really putting aside and provisioning properly for tax. It shouldn't just be a last minute rush at the end of the line. This should be something that you're having a regular conversation, and you shouldn't be, at the end of the year going, what the? I didn't think it was going to be that. Yeah. It should be, I know it's going to be that, and I've got that sitting there ready to go. You don't want to live life other than that way. So another little one here, Josh, for new starters.
Yeah, new starters. Super. This one can be a bit of a trap if you're not aware of your requirements there. So it's really important to be paying staff super on time. So a quick reminder that super is due quarterly, and it's due by the 28th day following each quarter that the super was actually withheld. So you do need to make sure you're not waiting to the very last day as well. So you don't want to wait. So say for this quarter, the June 24 quarter is due by the 20th of July. You don't want to be sending it on the 20th of July because you've actually missed your timeline. It actually does need to leave and get to the super fund by the 28th. So always be mindful of that. And the likes of Xero, etc., through Auto Super, make this very easy these days to keep abreast of your super. And the key thing is it's only deductible when paid. And paid on time. So if you miss that timeline, it's not deductible. It's not just not deductible for that point, it's permanently not deductible anymore. So on time. And for this year, because we're at this point in the year, we're in June, if you're trying to get the deduction for this quarter super this financial year to help manage tax, you'd want to be pushing that payment pretty much ASAP right now.
Any day. Yeah.
After you finish this webinar today, go and do it, basically. So that's just a quick reminder on the super front.
Yeah. Good hygiene is the way to go there. I mean, I think longer term, we're like down the track, 25, 26, can't remember. We're going to same day super, so payday super.
Same payday super.
So getting ready for that, at least trying to get it done properly quarterly if that's where you land, and making sure that it's in by the 28th of the following month. And then you can claim it as a deduction. Righto. Are there any questions at all? There was one in there about suggestions for good logbook apps for logbook requirements.
Yeah, we threw that in there. I don't know whether you see the answer there, Phil. It's either driver's note or GoFar. They're probably two ones that we see in practice. They're really easy to use.
Any questions on vehicle expenses, home office, any of that content that we've covered at all? Suze, looks like you want to jump in there.
I was just going to add with the logbooks, an app is great, but there's nothing wrong with using an Excel spreadsheet as well. So if you don't want to go to the extent of an app, although some apps are really good in terms of actually connecting with a vehicle. So if you're running multiple vehicles, you can track multiple vehicles in the same app. So have a look at some of those.
Yeah. The WIP question, how often? Monthly.
Monthly.
So I know this is a tax webinar. That's probably more of a commercial accounting question, but really you should be doing your monthly accounts, and those accounts need to include a WIP item. And if you're doing that, you'll be able to, I guess we use a sort of term, normalize how your profit looks. Yeah, because if you don't have that in place, you're going to have big month where you had a claim and you had income coming in the door, and then the next month you're going to have potentially like a 20-30% down loss because you've had a whole lot of costs go out the door. It just depends where you're up to with claims, with projects, etc. And so WIP is the tool that you use to recognise the work that's in play and the value of the work that you're already into that you might not have invoiced. It could be a positive or a negative depending on where you're at in those projects. But monthly, along with the other account reports that you're running. Time apps for timesheets. Well, we do.
Depends. You're using Xero, David. If you're using Xero Me is probably the neatest little function to use. Outside that, Phil mentioned this earlier. There are the likes of deputies.
Yeah.
Yeah.
stuff in the market as
Found
well. to
you
capture.
is another one. There's a range of them. We just like the fact that if you're using zero, obviously you've got zero me right there anyway. I think it breaks if you've got something like 500 staff or something like that. There's some limitations, but we'd probably be right there.
Yeah,
But
and
we
if you're
like
running,
I think we're right there. Yeah.
if you're running payroll through Xero, it makes sense to connect your timesheets that
Yeah.
way as well, because it all integrates so nicely. Whereas running something like Deputy on the side, you've got to track all your timesheeting in Deputy, import all of that into Xero, et cetera, et cetera. So it really just comes back to what's going to be most effective and efficient for you in running that. Xero
Yeah.
works, Deputy works, yeah, all of those things.
claiming fuel costs for employees when you supply fuel cards for them. You both
Best
get
way to claim fuel. Yeah.
answer.
Yeah, I'm just trying to work out answering Suze, Daniel, on you'd be naturally claiming it if you're giving them fuel cards anyway. Isn't the business already paying for?
Is that maybe like, there's an assumption that not all the fuel is for business? Because if the fuel is for business, then you're claiming it. Yeah.
Yeah, that's what I think,
Yeah.
Daniel. If it's all for business, then you'd be naturally claiming it anyway. Some of it's a bit of a best practice policy too. One of the simplest ways to really demonstrate its business use as well. Ideally, you don't have your employees using your business fuel cards on like Saturdays and Sundays going up the beach. Ideally, that's not what you want. It's a policy-based thing too, though, isn't it? So it's like you really didn't have a business policy to go, look, fuel cards for business travel. And if that's the policy you're running and you're sort of keeping track of that, then basically, as you're paying for the fuel card, you claim it.
Yeah. If you're trading in a company and you're providing the vehicle, you're providing the fuel cards, etc., then you may be tipping into, we're not going to go into this today, but you might be tipping into FBT, fringe benefits tax land. And in that case, you've probably got them keeping a logbook or making some declarations about private usage as well. So just keep in mind that they can stem into a different area of tax, which we're not going to go into much detail on today.
Yep. Any other questions there? That was some good ones. We might, if there aren't, we might keep moving. So getting there. So at this point, you're starting to, do okay. You're not, things are hopefully getting a little bit more predictable in your business, and you're starting to turn an okay profit. And you're looking at the money in the business and thinking about how you can take that money out. And what's the best possible way from a tax perspective to do that. There's really, and look, I was actually talking to one of our associates yesterday. This is just an ongoing challenge that we find where there's this real blurring between the money that's in the business and your own personal money. And my business, I've put all this effort in to generate profit in the business. Well, that's just mine, right? It's really not. It's the company's money. And from a tax perspective, you need to consider, if you're taking money out of the business, what are the tax implications of that? There are really only three ways to take money out of the business for yourself. There's wages, and that's just a standard employment arrangement between you and the company. And so, super is involved and all those sorts of things. You can take a dividend out, and there's a whole range of ways of doing that. And we're going to cover one of those specifically in a minute. And then there are things called directors' loans or Div 7A loans, and we're also going to cover that too. But I guess this is a setup piece here to just make sure that everyone is very clear that the money in the business that's been generated by the company is the company's money. If you're taking it out of the company, you need to be very careful about how you do that from a tax perspective, which is an intro then to Suze, who's going to take us through this idea of having a company and then a trust as well.
Yes, as we're walking through the journey from newbie through to getting there, you may be looking at restructuring, particularly if you're operating as a sole trader up until this point. So you've got some reasonable money coming through now. You might be generating some good profits and probably paying a bit more tax than you'd like to. So you're going to be talking to your accountant about, is it time to move into a company, or should I be considering a trust? And that's a good question. There's a couple of different ways you can structure that. If you're based in Queensland and QBCC is an issue for you, you may be pushed more towards a company setup and structure with perhaps a trust as a shareholder. If you're in other states and it's not as sensitive in terms of financial requirements for your regulator, you might find yourself trading in a trust, with the company as a trustee. So there's a couple of different ways you can look at this. We're going to walk through a couple of examples, which basically, as we've got here, we might be generating around 600,000 in revenue. We've got some costs attached to that revenue. We're put in here 300,000 of costs, and that's including 100,000 of wages back to you as the owner of the business. We've got some operating expenses of another 200,000, which is going to leave us with profit of 100,000. Now, if we're trading in a company structure, at that point, you would pay tax on the 100,000 at the flat rate of 25% or 25,000 in terms of tax. If we're in a trust structure, you now have to make a decision on how is that profit going to be allocated. Do I give that profit to me as the owner and add it to my 100,000 of profit of wages I've already taken, or can I share my income with my partner and perhaps give that 100,000 of profit to my partner instead? So we're going to run the scenario where if you have taken 100,000 as your wages, we're going to allocate the balance of that profit to your partner. Now, if it's a trust that we're running through and we're just distributing it that way, you'll just have a raw tax amount on the 100,000 at partner level plus your wages tax. Now, if instead, so let's circle back. If we're still operating as a sole trader and that all of that 200,000 is income to you, you can't split that with a partner. You would end up having around about $65,000 of tax to pay on that income. Now, if we can share that income with a partner, whether it's via the company or whether it's directly from the trust, if it's via the company, your company has already paid, as I said, $25,000 of tax on that. If we then share that to your partner and they get the benefit of that tax credit, you could actually be saving yourself nearly $15,000 of tax. So this is where we're assuming the trust is a shareholder of the company's paid tax. If we push it directly to your partner anyway, you would still only be paying roughly around that $25,000 of tax. So you're coming in around $50,000 of tax, as opposed to the 65 if you were still a sole trader. Is there benefit in setting up a company or a trust to trade out of? From a tax perspective, yes, there can be. From an asset protection perspective, absolutely. It does make a lot of sense because you are getting the benefit of having that separation from personal and business assets as well. So we're going to have a look now. Sorry, in terms of trusts, there has been a bit of a crackdown by the ATO in relation to trusts. Now, when we say crackdown, they're just looking a little bit more particularly at the arrangements of how we're sharing income in a trust situation. If you've got adult children, and we're talking about sort of that late teens, early 20s stage where they might be at university and not really earning a lot of money, you might be looking at sharing income with them. And if you are sharing income with them, that's where the ATO is starting to get a bit particular about what you're doing in that space. What they're saying in that space is you can still allocate money to them, but you can't go over the top. So we can't just say, let's give all the profit to my 20-year-old university student where they've not actually received much of the benefit of that. It's all come back to me. I'm keeping the money, but I'm going to give it to them for tax. What they're looking at is you can still reasonably give them some of that money if they're getting the benefit. And that might be something like you've had to buy a car for them so they could get to and from uni during the week. You could say that car cost $20,000, so I can reasonably give them $20,000 from the trust. They've received that benefit. So there are ways still to utilize this trust and share income in that space. They're less likely to have issues where it's a spouse situation or partners that are sharing that income because it's coming into the family pool of assets and you're using it for the benefit of the family. But we do just have to be careful where it is adult children. The other thing to just keep in mind, and we had a question on this yesterday, was in relation to children that are under 18. There are quite restrictive requirements around sharing income with them. And you can only really share with them 416, that's 416, of income per year without significant tax consequences. So you don't have a lot of scope where they're under 18. Over 18, you may have some potential, but it really you need to be able to demonstrate that they've received the benefit. As partners or spouses, you absolutely can share in that income from a trust. I'm going to hand it back to Josh, who's going to have a chat through this fun Division 7A stuff.
Division 7A, or director loans is probably a bit neater, isn't it? So in the same vein that Phil opened this section on, that if you're trading in an entity, a company, and not a sole trader, you need to remember that money in the company is actually the company's money in the first instance, right? So it's not actually yours. The company is a legal separate identity and legal separate taxpayer. So we just need to manage how money comes out of these companies. So provision came in called Division 7A or director loans, basically saying that if you've got the access to the company tax rate and you've gone and used the money personally, the expectation is that you do end up paying the individual tax rate on that money. And so this provision came in a very long time ago. It's been around for more than 20 years, actually, this provision. So looking at how we manage this, so in the first instance, the loan itself doesn't necessarily attract income tax in the first instance. So it does require some careful navigation, though. So if the actual loan isn't initially, so you take a loan out and you're not putting the money back in, then the expectation is that you need to pay some interest on this money you've taken out and actually pay it back to the company in due course. So the interest rate that the ATO have posted, they call it the benchmark interest rate, and that's 8.27% as of now. It used to be sort of circa 4.5, so it's definitely come up over the years. And so basically, you need to put these loans on what they call commercial terms to actually pay it back. And all the ATO are really expecting is over the next 7 years, we want you to actually pay the personal tax on that money and pay it back. So how do we pay it back to the company? There's three sort of ways to do it. One way you can actually transfer it back to the company, probably impractical because all likelihood you've spent the money. So you're not going to be putting it back to the company. So the next two are really the options that you have. So you can declare wages from the company to yourself, and obviously part of that wage, rather than paying it to you, you'll just set it off against the money you've already taken off out of the company. The key thing with wages, though, it will force you to make a super contribution. So you do need to be careful there on whether you want to do that. Super contributions are also something to have a think about. It might be actually something you want to do, but wages would always attract super. The other more commonly used way of paying this loan back, in inverted commas, is actually declare a dividend from the company over the next 7 years, including interest, to basically pay it back, or essentially paying the requisite personal tax on the money over 7 years. The key thing, we won't unpack what franking credits mean, but basically if the company's already paid 25% tax on it, you won't pay that same 25% tax when you do declare the dividend. You will get a credit for the money the company has already paid tax on. So let's have a look at a case study, because it can be a bit quirky to manage Division 7A. Probably 9 times out of 10, you just need to be, unless you have a good strategy around it, it's probably not a good idea to just rip money out. But say you have a really great year and you've accumulated a bit of cash in the company, and unfortunately, your family car has decided to pack it in and you need to buy a new one. So then you're sitting there going, well, do I use personal money? Do I take a personal loan out, or are there other avenues to get money to buy this car? So you might be looking at personal loan rates, even up to circa 11% on some vehicles, depending on a whole bunch of factors. You might then go, well, there's all this cash in the company. Should we borrow the money from the company? And in this case, you probably could. So you take the money out from the company using this Division 7A, putting it all on complying terms, and you pay the money back over 7 years by declaring dividends. You have interest that you're paying back, and the interest may actually be lower than a personal loan. So that's an effective way of potentially using the company money to actually, maybe buying something useful. There isn't an overlay to it. If you're taking money out and there's a broader sort of investment purpose, you may end up finding it's a great idea.
Yeah, and yeah. Unfortunately, like we had this included as content originally as a warning, because
That's right, we flipped it.
So many times clients come to us, like new clients, and they just haven't understood that they have a director's loan in place. They haven't understood that that has to be paid back and that there's an interest component to it. Things like the interest then that's being paid when you pay that interest back to the company, that's a taxable event as well. You're going to pay tax on that interest. And, if you take, if it's bigger numbers, like, you take a $200,000 loan, over 7 years, you're looking almost, $238,000, $240,000 in interest over that period. So if you're not on top of your Div 7 loan arrangement, then it could really, really bite you. And I think it's just one of those tools that has been misused and misunderstood. It can be used. So we've given quite a simple kind of use case there.
Very basic one. Yeah.
Josh would love to go into a lot of detail on some more creative uses from an investment perspective. We don't have the time at the moment to do that, but I guess the big thing here is it's an option for taking money out. If you're doing it, you've got to be across why you're doing it.
And it needs to be managed. And look, it's been around since like the late 90s and it's still misunderstood. So it's one of those things to keep your eyes on it.
Yeah. Okay. We're going to go to questions here. We're at the end of that kind of middle section, about to round the horn into the final section. So there was a question here from someone who had said to us, what is what is the magic number in income to move from a sole trader to a company? And look, this is I reckon one of the most frequently asked questions in this space. What is it?
Who wants to have a crack, Suze? I'm happy to have a go, and you can support or have your view as well. But basically, what are you looking at? Our marginal tax rates, Dale, right? So there's two elements: there's income and there's risk, which we might just cover off in a second. If you want to look at sort of numbers, 120 is probably a bit of the number, and I'll explain why. Is up to 120,000 worth of taxable income, the marginal tax rate scheme for individuals largely matches the tax rate for a company on average. So up to 120 in your personal name, it's about 25%. So that's probably the simplest way of explaining the magical number. But to be honest, I think that's a bit of a byproduct thing. I think really the thought of going from sole trader to company is really more around mitigating risk for you as a sole trader. Obviously, as a sole trader, you're taking all the risk on. Companies, you get to put a separation between you and the public. In terms of primary risk, building construction is a bit quirky, that you can still be at risk even if you're in a company, but it does put that level of separation. But it's then talking about flexibility as well, flexibility of how you work with your income moving forward.
Can I give a slightly less accounting perspective on this? I think if you're in this industry and you're not just dabbling, like you reckon you're going to be here for a bit, just get into a company. The benefits from like asset protection. So like if things go south, if you're looking at insolvency and those kind of things, then your personal assets like your home are protected or largely protected. There's always caveats to this stuff. But really, if you're going to be around in the industry for a while, you really need, there are a range of benefits that come from having a company. For example, that money that is taxed in the company at 25%, not the full marginal tax rate, you can then use that money in the company to buy cars and things like that and start to build assets for the business, rather than having to, pay your full marginal tax rate and then go and buy, those tools and, cars and all those sorts of things as an individual, as a sole trader. So it just really, in the end, gives you a whole lot more options as well. Suze, do you want to add? Yep.
Yeah, just to add to what Phil's saying, it can be very much a commercial decision. If it's you on your own as a sole trader, it's probably, yes, there's some risk in terms of what we've been talking about with assets, etc., and all those other bits and pieces. But as soon as you start adding more people to the business and you've got more and more subbies working for you or more and more employees, it becomes a much more commercial decision, because it's not just you're looking to protect, it's also your employees. If you're also tendering for work, a lot of tenders, if you're doing bigger or commercial type projects, will require you to be trading in a company as well. So there can be other more commercial factors that play in terms of whether it's time to move from a sole trader to a company than purely just looking at a tax or risk type of perspective. It does come back to what you're looking at in terms of your space, where you're working, who you're working with, and the type of environment that you need in terms of getting the best outcome for you and your business.
Yeah. So there's not really a magic number, but once that number gets, something in the order of 100 grand, you probably, you're wanting to start looking at company for all those reasons.
And just to reiterate, that number of 100,000, 120,000, we're talking about taxable income, not total revenue there. So it's once you've got your revenue minus all your expenses, it's that number you have left with at the end of the day that you pay tax on. That's that magic 100, 120 that we're sort of looking at, rather than revenue. And revenue could be 600, 800, it could be 200 or 300. It's that number at the bottom that we're really looking at.
Yeah, yeah. I mean, some other technical things around, you know, if you've got contracts with people and then you have to move from a sole trader to a company, you know, you'd have to change the contracts potentially. Yeah, so the earlier you kind of do it, if you think you're going to go that way, the better, really. It's not super expensive to be in a company either. I think that's one thing that puts people off. Oh, sole trader's easy, you know, it doesn't cost me too much to maintain, but it really isn't that expensive to set up a company and maintain a company these days. Okay, we are going to keep moving because we're on this home stretch now. So nailing it, we're up to the last section, which is where, you know, we're probably doing pretty well now. We've got some decent profits flowing, and we need to be careful about how much tax we're paying on that. So I'm going to throw to you, Josh. We're going to talk about super first.
That's super, yeah. So we're starting to talk about really something that's stepping away from just tax management. We've got a bit of money we're making now. We want to start thinking about retirement, putting money into sort of more investments and how we can wealth create at this point. So we're going to just cover off on super and super contributions. So we've got sort of two major buckets of super contributions. And one is simply the deductible or pre-tax bucket, or we call it concessional contributions bucket. And the other bucket is the after-tax non-concessional bucket. So we'll just unpack concessional contributions first. So the concessional contributions includes the employer contributions, like the super guarantee contributions, and any other contributions you make where you're claiming a tax deduction for it. So the contributions caps apply here. So the concessional or deductible contributions cap is 27,500, goes to 30,000 from 1 July this year. And so that's including the 11% and any amounts you're claiming a deduction for. So that's the basic level tax contribution threshold. The next one is really the concessional carry forward contribution. So perhaps in the last few years, and this came in around 2019 financial year, in those earlier years, whilst you're still building the business, you may not have spent or directed a lot of money towards your super at that point. And so any unused caps in those prior sort of 4 years, 4 or 5 years, get to carry forward. So you had 25,000 caps back then, 27.5 in the last couple of years. If you're only using part of those caps, then the bit you didn't use carries forward to the next year. So you could be in a scenario that for this financial year, for instance, you could have unused deductible cap of, you know, circa 60K as an example. And so if you've had a particularly good year and you want to sort of catch up on lost contributions in the prior years, it's potential, and you'd have to check your caps to make sure this is correct. But you could put an amount of money in over and above the ordinary cap and claim a tax deduction for it. So that could be quite a big benefit. Now, perhaps you have some additional money, so maybe you have an inheritance, or you just simply have a bunch of money that you've accumulated after tax, and you sort of want to prop up your super. And this always needs to be done with a bit of a strategy too. So the caveat to all this is make sure you're talking to a financial advisor before you go dumping a bunch of money into super. But non-concessional cap, after-tax money, the cap's 110,000. And so that's then moving forward to 120 from next year. So you can really get some money into super at that point using after-tax funds. Now, there is a flip to the carry forward. There's a non-concessional bring forward. So what you could do if you really want to get a decent amount of money, and so we'll use this year as an example, you can bring forward the next 2 years worth of non-concessional cap, to this year. So the cap this year is 110. You could bring forward the next 2 years at 220. So you could potentially put 330,000 in non-concessional contributions in this year. And as I mentioned, it's after tax. So you don't get any additional tax deduction for it. But that's how the sort of super caps work in that space. Now we might then moving on to structures. Let's just have a quick unpack on complex structuring. So maybe we're really starting to spin off some money now. We're really generating some profits, and we might start having our sights on looking at other sort of projects now. We might have a look at, we're going to do some wealth creation over here, maybe some property development as well. So this is really when you've got profits flowing and you're starting to think about succession, retirement planning, etc. And we really need to start using the power of structure. So that's what we're saying, is using legal entities or separate legal entities in strategic ways, just to make sure that we're mitigating a bunch of things. And so in terms of the why, the real big question around, or the big why, is we mitigate our risk by using complex structuring. So we just want, it's the whole eggs in one basket concept. You just don't want to throw everything into one basket. Having the risk of building constructions, we feel, and Sue's been talking about as well, there's a lot of risk involved in this. So you just need to make sure that we're putting the risk in sort of little buckets and making sure that we're not blending the risk together. And structuring is also a great way to then be building wealth in investment vehicles, potentially accessing lower tax rates if you're using companies, etc. It is also very important. And the last thing around here is structuring is very important when it comes to regulatory requirements as well. For the likes of QBCC, ICARE, or even VBA in Victoria, you just need to be careful around the structure you're using, and as well as not blending everything into one sort of level of risk. So there's a number of different ways you can do structuring. There's a few examples here. Now, we didn't put this slide here for me to unpack every structure we've got here and that each use, but what we just want to highlight here is that there's multiple different ways that you can structure your group, and the whole idea is just mitigating risk and wealth creation. You can stack this in different other ways as well, but all we're pointing out is you need really good advice. Proactive advice around structuring is the key thing we want to highlight, that you really just be on the front foot, talking with your accountant, being proactive on what we're planning for with our structuring. Now, Suze, let's do a bit of a light dive into this lovely property dev space, eh?
Absolutely. So as Josh was saying, when we get to this stage where businesses are starting to really nail it and see some good wealth and income being generated, we often will look at, we'll see builders particularly delving into this space. And why not? You've got the knowledge, you've got the skills. Why not dabble in a few of these other little projects? Now, there's a big part of this about how it's going to be taxed is what type of purpose you've got for the development that you're undertaking. We've got here the words capital investment, income generating. What does that actually mean? Largely, it means, are you doing the project to generate income, as in you want a quick turnaround, put some money in, get some money out, make money on it? Or are you looking at it as a long-term asset owning, generating type of capital growth type of project? And both of those situations could potentially have very different tax outcomes. And that's really what we're driving at here. The main thing about all of these projects is making sure that you're getting advice at the beginning, not when you're 3/4 of the way through, not after you've sold the project and you're suddenly like, oh, I might have a tax issue here. Get advice even while you're still thinking about the project. You might have identified a site that you're looking at. You might have had a chat with someone else you're working with, and you're both looking at, we could really do this and make something of it. That's the point you need to have that conversation with your accountant. Unintended, excuse me, unintended consequences that we see frequently is people not realizing that a lot of these projects can actually be subject to GST. Just because you're doing it from a property, it's a quick flip thing. I just want to buy it, fix it up, and I'm going to sell it, doesn't mean it's excluded from GST. It actually could fall very heavily into the GST space and could mean the difference between you making healthy profits and really squeezing those margins, as you've experienced in business, on a project such as this. So really getting that advice up front is key. Running the numbers when you're doing it as well, to make sure that what you expect in terms of profits is not going to be eroded by the tax consequences that you hadn't thought about. So get your accountant involved early. Have a look at whether there are potential GST implications. And the other one, and Josh touched on this a bit earlier, was if you're doing it as a main residence, or you're saying, I'm going to live in the property, do the renovations, and then sell it, is it really going to be subject to an exemption under capital gains tax, or could it potentially actually be subject to capital gains tax and not fall under the main residence exemption? So it's very critical to understand that as well, because unintended tax consequences can really make or break a project in this space.
Just
Phil,
quickly,
you want to chime in?
Suze, just capital gains tax, main residence exemption. There's a lot of jargon for, I'm sure there are people on the call who knows what that means, but for those who don't, How does it just, and really basically capital gains tax and main residence?
So as Josh said before, property actually under the tax laws is all property is subject to capital gains tax. That means if you buy it at say $300,000 and you sell it for $500,000, you've made money. There's $200,000 there that is called capital gain. And you've made money on that. The ATO would suggest you potentially have to pay tax. The main residence exemption is where you live in the property. It's actually a carve out in the tax law that says you may not have to pay tax on that because you live in it and it's treated as your main residence. So there's actually an exemption sitting there. Now, there's a whole bunch of rules that sit behind whether you actually are entitled to that exemption, whether the exemption will apply on the whole property, on part of the property, on part of the time that you owned it, or all the time that you owned it.
But in
There's
principle,
so much that
main
goes
residence, you don't have to pay capital gains tax. And then the other part, I guess, if it's a capital play, it's a longer term piece. Yep. There's a discount off that capital gains tax, yeah?
Correct, yeah, correct. So there's all sorts of factors that will come into play, and that's why it's very important to get that advice. If you're starting a project or looking to sell the house that you live in, it's really important to get some advice around what potential tax implications might fall out of that. Now, on the next slide, we've got here a whole bunch of different projects that we see a lot of people starting to dabble in this space. Flipping, as we mentioned before, so you're buying a property, renovating it and selling it. You'll see the point down there, renovation could be small or major. There are different tax implications depending on whether you're just doing a little bit of a touch-up or you're doing what they call a significant renovation. So again, good to get advice around that. Question starts to come into play whether the first one might be okay if you're living in it and you can get an exemption, but how many times can I do it before the ATO catches up with me? That again is something to have a chat with your accountant about. Splitting is another one we see frequently these days, where you'll buy a larger plot of land. It might already have a house on it, and you'll split that into say 2 or 3 different blocks of land. You might sell vacant land, you might build on it and sell it, you might keep some of it, you might sell all of it. All of that again has big tax implications and different tax implications depending on what you're intending to do. 2 packs, 3 packs, 4 packs, all those sorts of things. And share housing is becoming another one that we're seeing quite frequently these days. With the housing crisis particularly, people are looking at how can I maximize my return on my property? Can I open it to share housing? Am I subletting? And NDIS is also coming into the fray. And I've had a couple of clients recently looking at converting some of their existing rental accommodation that is in fact a share house in one case to NDIS housing, and looking at generating greater returns for them on that income and on that investment as well. So loads and loads of different opportunities in this space. The key thing, as we've been driving through the whole webinar today, is get some advice. And particularly when you're starting to look at these type of situations, it's really imperative to get advice on what the tax outcomes might be for you, depending on what the project is.
Yeah.
Joshy.
Self-managed super. We're going to touch on this light because it's an area that you just need to proceed with caution. Here's the obligatory disclaimer. This is general only. You must talk to a financial advisor before you dive into this, because self-managed super is a financial product. So make sure you're aware of that. But we just want to unpack a quick example of what we see in practice happening these days. So self-managed super at its core means that you get to take control of your superannuation. You're taking control of your retirement money. So you do need to be careful around that and be sort of conscious of what you're trying to achieve. A very common use for self-managed super, particularly in the building construction space as well, is for business owners who might need to actually buy a commercial premises now. They might need an office space or a storage space, and they use their self-managed super to do that. There are some very strict rules around how you need to manage that. It needs to be all at arm's length, market rates, all that sort of stuff. It needs to be considered. And the core thing is that super is still eligible to borrow money. You can borrow to buy an asset in super. It does need to be done in a very specific way. Our ebook actually unpacks how to do that. But the big attraction for super, and self-managed super particularly, is that it's taxed very low rate. So we've got 15% tax rate on earnings in super and 10% for capital gains. So it is an attractive strategy. Let's do a quick example of why does it look good. So your company generating great profits, you need this space. So it's the question of, do I rent or do I buy it myself and rent it to myself? So say your rent that you set at arm's length between you and your super fund is 50,000. You're going to get a 25% tax deduction in your company for that 50,000 rent because you're paying it to your super fund. It's taxed at 15% in the super fund. So immediately it's a 5K tax benefit for doing that. But if you had to pay the rent anyway, the tax benefit was probably already there for the company. But the key thing you're then focusing on is growing a valuable investment for yourself. So you get some tax benefit from being able to rent the property from yourself, but you're also then taking control of your own investment or retirement investment as well that you control. So there you go. There's a quick unpack of self-managed. We do have a look at that in our ebook as well.
Righto, we're nearly there, guys. Take some questions. So I mentioned at the start, if you are on fire from a tax debt perspective, there's quite a good option in the market now. It's called Small Business Restructuring Process, SBRP. It's an option if your debts, unsecured creditors' debt is under $1 million. You have to have had your superannuation. It has to be up to date. So this won't work for you if you don't have your super outstanding for your employees. As opposed to other insolvency options, you don't have to hand control over the company. You stay in control, so you don't hand over to a liquidator. And I guess the whole principle of a small business restructuring process is that you go to your creditors and you make an offer to them. And that offer, in terms of what we're seeing in the market at the moment, is really quite good. So we're seeing, and we're doing a number of these at the moment that are somewhere like 20 cents to 30 cents in the dollar. Quite often, the main creditor is the ATO, because we have businesses who have just gotten themselves into, maybe they've had fixed price contracts that haven't gone well for them, and so they've just ended up, stacking up a fair bit of debt to the ATO. And so we make an offer of, say, 20 to 30 cents in the dollar, and 90+% of those are going through at the moment. We're not sure how long the ATO is going to be amenable to that option, but they certainly are going through pretty well at the moment. If you're in Queensland, I know there are some people in Queensland on the call. The QBCC, if you're insolvent or bankrupt, that's not good news for your license. Whereas with SBRP, it's not a problem. They may want to call for an MFR report afterwards to make sure that you do pass their financial requirements, but it's not an insolvency event in and of itself. If that's an option for you, then let us know. If you know someone who's got a fair bit of debt, this is a great tool that is available to us now, much better than having to close the doors. So we have the free ebook. It's coming out. We'll let everyone know. We'll be sending an email with a link so you can download that. And again, it'll just cover off on some of the topics we covered today, well, all of them, and some more detail. The last poll of the day, Jules, I hope you're still there. Can you please run this last poll? So this is about if you wanted to get in touch with us, we're happy to. We've got some slots available over the next couple of weeks to be able to just do a free, I guess it's like a second set of eyes over how you're traveling from a tax perspective. We're more than happy to offer that to Mitre 10 customers, clients. So just tick the box there. Equally, if you wanted to chat to Jules and the team at Build Xact about how how their software works or getting more out of the software, then tick that box. Or you can chat to both of us if you wanted to. That's it for the content. I know we're pretty much 11:30 now. We're happy to take some more questions though, and I know there was one in there about company and buying the company buying property off you, etc. If people do want to trickle off now, that's fine. If you want to stay while we answer these last questions, that's fine too. If you're going, thank you for coming, and thank you for leaning in on this subject. But yeah, we're happy to just take a few more questions now. Jules, did you want to jump in?
Yeah, you can hear me, guys?
Yep, loud and clear.
Awesome. Hope everyone got a good value out of all my wisdom that I was giving to everyone there. I appreciate you guys. So Peter, I'll read. Hold on a second.
You'll answer that one, Jules, for Peter.
Yeah, I'll do that right now. Once I plug into Google. So
Well, I think
Peter's-
we can all read it.
Yeah.
Josh, Sue wants to answer that one.
Yeah, look, it's always possible. There's never anything that's impossible in these situations. The question is, what's it going to cost you to make that happen? So the big thing to consider when you're looking to sell a property from one entity to another, whether it's in your name or whether it's in a trust or whatever, into another entity, is twofold. You will have a potential capital gains issue to consider in the entity that you're selling it out of, and the other is stamp duty. Unfortunately, in pretty much every state across Australia, you are going to have a stamp duty issue on property when you transfer from one entity to another. So you do have to just weigh the costs against the benefits of doing that. We have had instances where clients have looked at that and actually said, yep, I'm happy to pay that, and gone ahead and done the transaction. And put the property into a company so they could then do the development, etc., in that space. And we've had others that have looked at it and said, yeah, you know what? Nah, I'm not going to pay that cost. I'd rather keep it, do it the way that I'm going to do it, or look at an alternative way of structuring the development costs against the land holding entity. So there are quite a number of different ways you could approach it. It's again worth a conversation to go through and look at your specific situation.
I think, Peter, you know, that's probably even one that, you know, if you didn't tick the box, like we'll send out, you know, a follow-up video. You can certainly get back in touch with us. We're happy to, you know, have a chat to you about that one separately. Additional tax benefits for purchasing electric vehicle. I guess there's this increase in the threshold for luxury car tax is one of the benefits there.
One of the key benefits is just an exemption from FBT, and we mentioned fringe benefits before.
Yeah.
But it's got to be a full electric vehicle. It doesn't apply to some of the hybrids and different things like that. So it's got to be a full electric to get that FBT benefit.
Yeah. Just a reminder on the FBT benefit. If you do buy it, it is exempt from FBT, but it is still a reportable fringe benefit as well. So just be mindful of the reporting around it. But
and if you're not quite sure what Josh means by that, it's time for consultation and just discuss what that actually means.
I'll plant a seed. Grab a call with us if you need to unpack it.
There's one that's come straight to us as hosts about business trips. How do we make use of family trips? So this is like the age-old, I'm going on a family trip, can I claim it for business? Or I'm going on a business trip, can I take my family? And, you know, how do I, you know, make sense of all of that from a tax perspective?
Joshy, do you want to take this one?
Short answer is it's neither all in or it's neither all out. It's basically how much of what you're incurring relates to actual business. So that's probably the simplest way to break it down. It'll just be proportioned in some way.
Depending on how long it's for, you might have to keep a diary showing what you did on each day.
And everything.
Did I go to Disneyland or did I go to the conference? So it just depends on what you're actually doing and how long you go for.
I think there's a principle at play here, which we started off with, which is, you know, like balancing the tax law versus the opportunity. And in doing that balancing act, you just need to say, when I explain this in an audit, how will that stand up with the ATO? You know, that's probably a good sort of way of shortcutting it. Same with any of those kind of like how much is business versus like for the car, for the phone, all those sorts of things. You know, if you really, as we say, you know, if you're taking the piss, then that's probably not going to stand up.
Yeah, one of the tongue-in-cheek ways, Phil, is to say, look, can you stand there on the stand and go, Your Honour, I promise that this is for this purpose. So
because it's just not worth the pain, I reckon. And really, how much are you going to be able to claim, really? So that's that one. I don't think there's any other questions in there that I've missed. So I reckon we're it.
We're wrapping. This is good.
Yep. Thanks, Jules.
Excellent. Thanks, Jules. Thanks, Mitre 10. Thanks, everyone.
Thanks, everyone. Thanks for joining.
And Jackie as well over at Build Xact for helping put this all together as well. It's been great.
Yeah, absolutely. Thanks, guys. Really appreciate having on, and for everyone that joined as well.
Yeah. Thanks.
Awesome.
Brilliant. Thanks.
See you around.
Bye.
Thanks, team. Bye.